Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, May 3rd. Hope you guys have a wonderful day here. We got a lot of data to go over, so we're just going to jump right into this right away. And we'll start off with sorry about that, weekly jobless claims that we get every Thursday. So last week we had 209,000 people apply for unemployment. Or the report came in at 209,000. Forecast was supposed to go up to 225,000. It did go up a little bit, but only by 2,000 to 211,000. These are great numbers here. Again, these are, if you haven't heard it before, this is multi-decades low, all-time low. We haven't seen these since actually like the 60s, this low of people applying for unemployment. So these are great numbers we're seeing here. We also got productivity for the first quarter. So the previous report came out at 0.3%, and the forecast was supposed to come in at 0.9%. Didn't quite meet expectations, but still came in a pretty good number here at 0.7%. Also got unit labor costs for the first quarter. So the previous report came out at 2.1% increase. Forecast is supposed to go at 2.8%. And this didn't come up to expectations, 2.7. So cost didn't rise as much as we thought, which is obviously a good thing. Because this could create obviously an inflation number, and that's been a pretty sensitive topic, as we'll kind of touch base on that here in a little bit. We got next to our services industry, so kind of like the manufacturing we saw earlier in the week between the market and ISM, we got kind of a mixed one here. So anything above 50 on these two indexes is still positive territory. So the market services PMI for the month of April came in at 54.6. March was at 54.4, so it went upwards. ISM, non-manufacturing index, or also known as services industry, went from 58.8%. Forecast was at 58, and it came a little bit lower than expectations, down to 56.8. So again, services showing going upwards, ISM showing it going downwards, like we did with manufacturing. So it's kind of a mixed report between these two. Last but not least, we got the factory orders. So the previous report came out at 1.6% for the month of February here, and forecast for March was 1.4 and exceeded that 1.6%. So overall, pretty decent day for on the economic calendar. So let's take a look here. Stock market is currently down. The Dow is actually down like 370 points so far this morning. A lot of it comes into earnings reports that came in, and which is kind of what's putting in there. It was a lot of disappointing earnings reports. 29, I think, of the 30 sectors in the Dow were actually down in negative territory. Part of it was this, and then the part of it was, we had the FOMC announcement yesterday, and that created to investors a little bit of uncertainty. Because they did mention something about rising inflation about the 2% range, and so they're kind of concerned that potentially we could have 3 more rate hikes, so a total of 4 for the year. Now it's expected at the June meeting, the next one will have a rate hike. And then probably in September will be the next rate hike. So the December one looks like it could be up in the air. But from reading a lot of different economists so far, most of them project by the policy statement the way they were reading it, they don't think the Fed is going to have any knee-jerk reaction to any fluctuations. They understand when they use the word symmetric that there could be some fluctuations in the inflationary numbers. So even if it goes up a little bit above 2%, they're not going to have a knee-jerk reaction, automatically add another one. Just like they didn't have a knee-jerk reaction when the last year when the inflation was going downwards. Remember we hit right about this time we were at 1.8 on the Fed, went all the way down to about 1.3. So they didn't have a knee-jerk reaction and start pulling rates or stopping rates. So they think they could have some fluctuation. They'll expect some fluctuation in the midterm here, and probably keep an eye on it until about September. And if it looks like it's really heating up, it has to come out with the biggest thing with inflation will be the wage earnings. Unless we're having a really overheated market, that looks like it could really push us maybe even over 2.5% core on the core side of things, then they might get that additional one in there. But as long as we're between 2 and 2.5%, they don't think they're going to. Most economists are kind of thinking out that they won't. But in the midterm, investors are not necessarily economists, and they're going to probably have these emotional swings. So that's why you're going to see some volatility in the midterm on the stock market with these concerns about inflation. If you hear anything about inflation, so tomorrow we got the jobs numbers, which will be out, but also we'll have wages. Talk about wages. Remember back around January, February, that came out and that concerned inflation, and now so the market start tanking. So we could see something very similar to that as well. Also, we have this week China. We have some officials in China, Beijing, speaking with the Chinese and the U.S. officials are discussing trade. So that hopefully we don't get into a trade war and avoid, the tariffs. Kind of avoid. So this is something on their minds as well because they're concerned about the protectionism not be able to expand as much as they initially thought we would be able to prior to the talk of tariffs. And that's what's kind of the headlines so far today. Let's take a look here at the bond market, and bond market's up about 20 basis points so far. Because the stock market is tanking, a lot of money is being positioned into the bond market, and it's helping out interest rates. So we have an improvement in interest rates today here. On the other hand, we got yields. Yields is breaking below its floor of support here. It's down to about 2.93 right now, which is good for us. But tomorrow, again, we got the jobs reports. This could be kind of a knee-jerk reaction prior to that. And, maybe, if we get a really hot jobs number and inflation isn't so bad, this could quickly reverse and go the opposite direction. The stock market could take off. And, again, bond market go back to the opposite side. So if you're out there floating around with interest rates, you may want to keep an eye on that. That could be today could be a good day to kind of lock in if you are currently in a transaction and don't haven't locked your rate yet. So it might be more of an upside protection-wise rather than falling all the way down here or even down here again versus, we got this ceiling resistance, we got 3 levels up here. There's a little bit of room here, but again, it may not be worth the risk of potentially falling further down. All right, so hopefully that helped you guys out. I hope you guys have a wonderful rest of your day. But if you guys want more data, just come over to Twitter. You can find me at Mike Bjork. Follow me there, and you can get the updates throughout the day that you might want to see. All right, you guys have a great rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.